Welcome to the Deep Dive. We're Talk Tickers, and we're here to really break down earnings calls for you.
Get you those critical insights.
Exactly. Today, we're jumping into Lockheed Martin's second quarter 2025 results. Pretty interesting quarter for them.
Yeah, definitely a lot going on.
So the plan is, we'll hit the key numbers first, then really unpack the big challenges, the charges they took this quarter.
And then balance that out with the operational side, because there were some impressive highlights there too, and look at their strategy going forward.
Right. Our mission, like always, is just to cut through everything and give you what you need to know, what really matters here.
Couldn't have said it better. This quarter really is, well, a tale of two cities for Lockheed.
Yeah.
You've got these big financial hits from some tough, older programs.
Legacy stuff.
Yeah, legacy stuff. But then you see their tech performing incredibly well out in the field, and demand looks really strong. It's quite the mix.
Okay, let's get into that mix. Starting with the results snapshot, sales.
Sales came in at $18.2 billion for Q2. Basically flat compared to last year over year, but up a bit from Q1.
Okay, and they're still investing, right?
Oh, yeah.
Yeah.
Pumped $800 million into infrastructure and, innovation, keeping that pipeline full.
And shareholder returns, always a focus.
$1.3 billion return this quarter, so they're sticking to that commitment.
But the big headline, the elephant in the room, these losses.
That's the main story, financially speaking. A total of $1.8 billion in charges. That's spread across a few programs and one specific tax issue.
Wow. $1.8 billion. How did that translate down to earnings per share?
Well, that's where you really see the impact. The GAAP EPS, the official number, was only $1.46.
Only $1.46.
Yeah. And the reason it was so low is that these charges reduced it by $5.83 per share. So, without those items, it would have looked very different.
Okay, that puts it in perspective. So let's dig into those items. This $1.8 billion loss, what's in there?
So the operational part of that, the bit that hits segment operating profit directly, was $1.66 billion. And the biggest piece by far was a classified aeronautics program.
Classified, okay, how much?
An incremental $950 million reach-forward loss on that one program alone.
$950 million. What exactly is a reach-forward loss?
It's basically accounting telling you they now expect to lose that much more money on the contract in the future than they previously thought. So they have to book that expected loss now.
Why this sudden change? What happened?
Management talked about ongoing challenges, things like design, integration, testing, basically the complexities of getting this advanced tech working perfectly. These issues apparently stretched into 2025 and hit the schedule and cost harder than they budgeted for.
That sounds tough.
Yeah.
But they still believe in the program itself.
Oh, absolutely. They call it a game-changing capability, crucial for the U.S. and allies. They're not backing away from the tech.
So what are they doing about the execution problems? How do they de-risk something like that?
They seem to be taking it very seriously. They mentioned changes in the program leadership, bringing in experts from other parts of Lockheed.
Okay.
And implementing a full-scale risk review and corrective action plan. Sounds pretty comprehensive.
And they mentioned a policy shift too, didn't they?
Yeah, that was interesting. They reiterated this policy of no must-win programs, trying to signal they won't take on contracts in the future that have, unbounded risk just to win the business. Learning lessons, hopefully.
A clear message, yeah. Okay, what else was in that $1.8 billion? There was the Canadian Helicopter Program.
Right, the Canadian Maritime Helicopter Program, CMHP. That was a $570 million loss.
What drove that one?
It came out of talks with the Canadian government. They basically agreed to provide more capability upgrades, better helicopter use, longer life for the fleet, which is good for the customer. But
it will cost more than planned.
Exactly. It ate into the expected future profits on the contract, forcing them to recognize it as a loss now. They're still talking about maybe restructuring the contract terms, though.
Okay. And then there was a smaller one, the Turkish Helicopter Program. TUHP.
Yep, $95 million loss there. That one was more straightforward in a way.
How so?
It was mostly down to U.S. government sanctions against Turkish entities. Just made it impossible or very difficult for Lockheed to perform their side of the contract. Geopolitics interfering with business.
A reminder that these things don't happen in a vacuum. Okay, one more big item. The IRS tax claim. That sounded potentially huge.
Yeah, that's a separate issue from the program charges, but still significant. The IRS is saying Lockheed owes an additional $4.6 billion in income tax.
$4.6 billion, that's massive. What's Lockheed saying?
They fundamentally disagree strongly. They argue the IRS actually approved their accounting method changes way back when.
So the IRS changed its mind.
Well, Lockheed argues the IRS's current approach creates this mismatch between when they recognize revenue and when they book expenses. So they're fighting it, going through appeals, maybe court if needed. They did set aside $100 billion for interest just in case, as a reserve.
So a big potential liability hanging out there, but they sound confident.
They sounded pretty confident they'd prevail, yeah.
Yeah.
But it's definitely something to watch.
Okay, so summing up the challenges. Complex programs, cost overruns, geopolitical issues, a big tax dispute. It sounds like they're trying to clean house a bit, maybe, setting a new baseline.
That's certainly the narrative they're pushing. The idea of de-risking, new management oversight, learning lessons. But, the proof will be in the pudding going forward.
Right. But it wasn't all negative news. Let's shift gears to the operational side. Their systems are actually being used in combat and performing well.
Yes, and they made a point of highlighting this. You had the F-35 and the F-22. They're stealth fighters, leading recent U.S. operations in the Middle East, operating undetected, providing air dominance, real-world proof points.
That's significant validation. Anything else?
Definitely. The PAC-III missile Patriot Advanced Capability 3 had a successful intercept of ballistic missiles targeting U.S. forces over in Qatar. Yeah, a direct hit, showcasing that missile defense reliability. And they also mentioned TUHP, Aegis, and the LRDR. That's the Long-Range Discrimination Radar.
What did the LRDR do?
It successfully spotted and tracked a live ballistic missile threat and fed that data right into the wider Missile Defense Agency system. So these aren't just exercises, the systems are working under pressure.
And that kind of performance must drive demand, right?
Absolutely. Customers see this stuff works and they want more, faster. You see it in the budget requests.
Nice.
The U.S. government's focus on homeland security, deterrence. It's translating into likely big increases in spending on munitions.
Like PAC-III.
Exactly. The Navy wants to buy PAC-III for the first time ever. And the Army is asked to quadruple PAC-III production. That's huge.
Quadruple. Okay. What about hypersonics? Still a big focus.
Huge focus. Nearly $400 million requested in the FY26 budget for ARRW production. That's the Air-Launched Rapid Response Weapon. And it's moving to production less than a year after the development phase, which is incredibly fast. Shows the urgency.
Any other highlights?
Yeah, the conventional prompt strike missile also had a good flight test. The Coast Guard budget includes more MH-60 Romeo helicopters, new ships needing command and control systems, more C-130J transports. Demand seems pretty broad-based.
And they locked in that big helicopter deal, too, the CH-53K.
Right, the King Stallion. Agreed on a price with the Navy for a 5-year, multi-year buy. At least 85 aircraft, lots 9 through 13. Deliveries start in 2029. That provides really solid long-term visibility for that program.
Good deal. Let's talk F-35 specifically. Still the crown jewel despite past hiccups.
Seems like it. They delivered 50 in Q2, 97 year to date. And get this, 207 since they restarted deliveries last year after some earlier delays. They're on track for their target of 170 to 190 deliveries this year.
And the tech upgrades are moving forward. TR3.
Yes, Technology Refresh 3 hardware integration is done. That's a big deal. It's like the brains of the plane, enabling future upgrades. And new software is rolling onto the fleet now, improving the pilot's interface, adding new capabilities.
And international partners are still buying.
Definitely. The UK, Belgium, Denmark all announced plans for more F-35s. Even though the initial US DoD budget request was a bit lower, Congress seems likely to add more back in. It's still the only 5th-gen fighter in production in, the Western world.
And they're already thinking of bridging to 6th gen.
Yeah. Management talked about using R&D from the NGAD program, Next Generation Air Dominance, and porting some of that tech or learning over to the F-35 platform. Kind of a best value bridge to keep it cutting edge.
Smart. One more point on operations supply chain. Any news there?
They highlighted the recent DoD investment in U.S.-based rare earth mining and magnet production. That's really important for things like the F-35, ensuring they aren't overly reliant on potentially unstable foreign sources for critical materials. De-risking the supply chain, basically.
Okay, so strong operational performance, clear demand signals. How does this all square with the financial outlook, especially after those big charges? What's the guidance?
Well, interestingly, they reaffirmed their full-year sales guidance for 2025, still expecting $73.75 billion to $74.75 billion.
Despite the charges. How?
They pointed to a really strong backlog, $167 billion, and they expect a lot of big awards in the second half of the year. Things like F-35 lots 18 and 19, more JSMM and LRDR missiles, that PAC-III production ramp. the CH-53K multi-year deal, and some classified space contracts. So they see the revenue coming in.
Okay, but the profit outlook must have changed.
Yes, that did change. Segment operating profit guidance is now $6.6 billion to $6.7 billion. That directly reflects the $1.6 billion in operational program charges we talked about earlier. Can't escape that impact.
Right, but then free cash flow guidance, that was also maintained. How do they manage that?
Yeah, that was notable. Still guiding to $6.6 billion to $6.8 billion in free cash flow for 2025. They said the hits from the classified program issues and tariffs are being offset.
Offset by what?
Mainly by tax benefits. They expect $400 million to $600 million in benefits, thanks to changes in how R&D spending is treated for tax purposes, basically, getting to deduct it faster. That's from the One Big Beautiful Bill Act. Also, they're not planning any pension contributions this year, which helps cash flow too.
Got it. What about looking further out, beyond 2025?
They gave a little color on 2026, said free cash flow could be closer to $6 billion then. That takes into account needing to invest more, and they do assume about a $1 billion pension contribution in 2026, so maybe a bit lower next year.
But still committed to shareholder return?
Yes, they reiterated their plan to return at least $6 billion a year to shareholders. So dividends and buybacks should remain robust.
Okay, so for investors listening, it really is the split picture, isn't it? Big charges cleaning up past issues versus strong current performance and future demand.
Absolutely. The core question is, was this quarter a kitchen sink moment? Did they throw all the bad news out there once to clear the decks and de-risk these programs for real? Or are there deeper execution problems that might linger?
And management's response, new leadership on troubled programs, more oversight, this no must win mantra that's all designed to convince investors. It's the former, right? That lessons are learned.
Exactly. They're trying to build confidence that future risks will be handled better. And, at the end of the day, their products are pretty essential for national security, for deterrence globally. That underpins the long-term demand picture.
So it's this tension between the financial adjustments now and the operational reality, the strategic importance going forward. That's what defines Lockheed's story right now.
Well put.
All right, let's move to our not financial advice segment. We always try to cook up an outrageous, maybe plausible trade idea based on the call. What do we got this time?
Okay, so leaning into this idea of contrasts, and maybe, just maybe, the worst being over on these charges. How about this? Consider a long-dated, out-of-the-money call option strategy on Lockheed Martin.
Long-dated calls. So betting on significant upside, but maybe not tomorrow, like over the next 3 to 5 years.
Exactly. This isn't just, defense spending is up. It's a specific bet that these huge charges, especially that billion on the classified program, really do represent a final cleanup, a reset under new financial scrutiny.
So you're buying into their lessons learned narrative and the idea that this game-changing tech will eventually deliver financially.
Kind of. You're betting that the market is currently over-discounting the stock because of these charges, and that once this program hits its stride and maybe gets de-risked in investors' minds, there's significant upside. Plus, think about that Golden Dome initiative they mentioned.
Right, the homeland defense thing, they're positioned as the integrator.
Yeah, with ready now capabilities. It's not in the backlog yet, probably hard to quantify, but it sounds potentially massive. A future kicker that isn't priced in.
And the IRS tax dispute resolution could be another catalyst if it goes their way.
For sure. If they win that, it removes a big overhang and potentially adds billions back conceptually to the balance sheet strength. So the trade idea banks on current pessimism being overdone and the true long-term value of these critical defense technologies shining through once this kitchen sink quarter fades into the background.
It's definitely playing the long game, betting on execution improvement and future catalysts. Outrageous, but plausible, perhaps?
That's the idea.
Okay, so wrapping it all up, Lockheed Martin's Q2. A quarter definitely marked by those big financial charges, addressing risks on some complex legacy programs.
But set against really strong operational performance, systems proving themselves in the real world, and a clear path to future demand driven by global security needs. It's quite the dynamic.
The focus now seems to be on tightening up program management, locking in those new contracts we talked about, and just executing to deliver that long-term value.
It's a balancing act for sure, but one they seem actively focused on navigating.
Absolutely. And just a reminder, everything we've discussed here is purely for informational purposes. It is absolutely not financial advice.
Please do your own homework. Talk to a financial professional before making any investment decisions.
Thanks for tuning into The Deep Dive. We always appreciate you listening, and feel free to reach out with any thoughts you had on today's discussion.